Hey everybody, happy Friday. Adam and Jen back with another market update. Adam, there was a lot happening this week with the Federal Open Market Committee meeting, wrapped up their meetings, and they've decided that, we're going to keep rates, and this is no surprise, keeping rates the target range at 0% to 0.25%. But the bigger picture is that all but 4 members say that they see us staying at that 0% target range until 2023. That is a really long time to stay in that range, but it's important to know what that actually means for consumers because it doesn't necessarily mean what people think it means.
Yeah, that's right, Jen. I mean, people see that headline and you're going to see it everywhere this weekend. Fed keeps rates at near 0%, which is really cheap. And so that's good news for the American consumer, for the borrower. But it doesn't mean that money is free, that your money, when you go borrow it to get a mortgage or a car loan or a credit card, that it's going to be 0%. That is not true. What it means is the bank who is lending you the money, they can go get the money from the government, from the Federal Reserve at 0% interest. The government is saying we want to stimulate the economy, make it easy for people to borrow and finance and bring their cost of living down. And so we're going to make this money available at 0%. Now, other market factors add on to that. And so mortgage rates, we continue to see those moving between 2.5% and the low 3% range for folks with good credit. Credit cards have fluctuating rates, same with car loans. So educate yourself on what a 0 or low interest rate environment means for you. It does mean low interest rate, but every product is a little bit different. All the market forces are a little bit different. You need to make sure you're talking to an expert, know the details, and more importantly, that you understand the broader economy. And Jen, this is good news for borrowing, but it's not necessarily a good sign about the health of the overall economy.
Right. So what the Federal Reserve is trying to do is stimulate inflation. All right, guys, because that's going to help the overall economy. I know it sounds weird to say we want your stuff to cost more, but that helps out everything. There's a really important strategy behind that. So by the Federal Reserve saying that they're going to keep interest rates this low for the foreseeable future until they see a bigger pickup in the economy, that means that right now we are moving at a glacial pace for reinvigorating what's going on because of the pandemic. So because of that, investors this week on Wall Street kind of got a little bit nervous or kind of cautious. They were expecting a much bigger jump sooner. And we're not probably going to see that with the economy, according to the Federal Reserve and their actions this week. So all those tech stocks that have been performing extremely well, there was another sell-off this week. So the NASDAQ slipped down into correction. The Dow snapped a 4-day winning streak. And so there's a lot of effects that way. There was some good news. Unemployment's getting a little bit better. But people still aren't spending money. And that's where we need people. People don't have the income right now. They're unemployed. We lost the stipends, things like that. So there's a lot of economic factors. You can't just look at Wall Street. Right now, it's just going to be a little slow moving, getting the economy back up and going. And that's what the Federal Reserve is trying to do. So how that directly affects you, there are more details for you available inside the market update. We have another update on housing in there as well. So read up on that. It's on movement.com/blog.